So how to invest 1 lakh rupees in India? That's the question that we are going to answer today. First, let's break down the question a little bit. And I did want to show you the portfolio curve that I have so that you have an idea of where I'm coming from and my background story as to why I'm making this video. Okay, so as of now you can see that I have close to 2.5 crore rupees in equity investments. I'm a majorly equity investor, however I do have other sources of investments as well, and I've grown this portfolio from scratch by building online businesses and then taking that money and investing consistently over the past 7 years into different equity and learning throughout this journey. Now, the reason for making this video about 1 lakh is because 1 lakh I feel is a good unit of economics to explain this concept and for you to be able to understand this investing strategy as to how you can split your funds and build a portfolio. So speaking about portfolio, let's go into the portfolio and I'm going to show you exactly my holdings, and then from there I'm going to derive the learnings that you can take away to invest this 1 lakh rupees. And once you know this and once you learn this, you could actually replicate it to 2 lakh rupees, to 5 lakh rupees, to 10 lakh rupees, and so on. However, as your portfolio size increases, you might want to increase the diversification. So I would say this video is best for people who want to learn how to invest a few lakh rupees in equity, right? So let's get started. First of all, as you can see, the important thing to look at is the portfolio split that a person has, and then we'll also understand what are the different instruments that we can invest in this 1 lakh rupees. Okay, so before we get into my portfolio, and I'm going to show you my biggest holdings as well and go through this in a deep dive manner. Before that, let's look at what are the instruments that we have. Okay, so when we talk about equity, we are talking about stocks. So let me switch to a mind map view so that you're able to understand this better. Think of this as a personal finance investing education so that you're able to understand the universe that you are dealing with. Okay, so the first thing inside equity, as you can see, we have the stocks. The second one is mutual funds, within which we have the actively managed and the passively managed mutual funds. And then we have the ETF. So this is the universe, right? And we will basically be picking from all of these things when we build our equity portfolio. Now, remember to hedge against for equity, for diversification, to hedge against equity, excuse me, with something like gold or silver or some debt. But in this video, the focus is going to be, I have 1 lakh rupees, I want to put it in equity. How can I do that in the most effective way for long-term returns? Now, remember the last part of the question is invest in India, right? How to invest 1 lakh rupees in India. So remember that actually we are investing in India. We are betting on India, that India will grow as an economy. Thereby, the companies that are Indian companies, the companies that are listed in India are also going to grow. So what is the universe, right? So the first things is stocks, and this is the most common thing. This is the one that you will find most videos on YouTube about, where people talk about different companies and individual stocks. The reason why this is so popular on YouTube is because you can create unlimited amount of content on companies. Always think of it from the creator perspective. If you were a YouTuber talking about fundamental investing strategies like ETFs or passively managed funds or index, you may not be able to make more than 100 videos because you'll basically cover up everything in a small set of videos, right? But if you talk about individual companies, you can basically make a living forever from YouTube, because you can keep talking about what Reliance did yesterday, what HDFC did last month, what IRCTC is going to do next month, which will be basically just fairy dust that you will be talking about. So that's the reason why I tend to stay away from individual stocks as much as possible, because I have a business to focus on. I have a family to focus on. I want to build a strong and happy family. I want to have my health and fitness, sorted. So yeah, I do not get into individual stocks. However, I did get into it when I was single, when I had a lot of time. And I wouldn't say a lot of time, but basically the period of the pandemic where I did have some amount of time during the lockdown, I was learning by swing trading in individual stocks. But if you dedicate full time to this, it could actually be a fulfilling pursuit. However, that being said, you should remember that most people who pick stocks or individual companies in the long run may not outperform the market, which brings me to the point of just investing and tracking the market, because that's the safest way to do it and that's the most passive way to do it. Okay, so how do we do that? Through funds. Now let's get into funds. This is my recommendation to a friend or to someone who would ask, or to just share my story of how I did it. But this is not personal finance advice. So I'm not saying you should put your money here, you do your own research, but I do not deal with individual stocks. Now, of course, there are some stocks that I hold in my portfolio, which I'm going to show you as we go into the portfolio section. But that's because these were the stocks that I bought long time ago, like Tata Motors, Bajaj Auto, Kotak, HUL, Tata Consumer, L&T, HCL Tech, Tata Power, ITC. Some of these are, well known. They're all large cap companies, but they were, things that I bought long time ago and I just decided to keep them. Or some of them might be paying me very good dividends, which is why I keep them. But that's not my major holdings. As you can see, like my top holdings, none of them are individual stocks, which I'll come to. So within funds, we have mutual funds that could be actively managed or passively managed. So what does this mean? Actively managed basically means that there's a fund manager like me, sitting here trying to buy and sell companies, make sure that it tries to outperform whatever index it's tracking. So for example, if it's a large cap fund, you want to outperform a large cap index. If it's a mid cap fund, your main goal is to outperform the mid cap index. If it's a small cap fund, your main goal is to outperform. So you get the idea. So actively managed mutual funds basically will try to beat the index, not one single index, but the index that they are referencing to. So for example, a mid-cap actively managed fund will try to beat the mid-cap index. However, in case of large cap funds, most large cap funds never beat the index, and this changes from year to year. So you might read all of these trending articles on Mint and Economic Times and similar websites like Money Control that this year large cap funds will beat the index. But that doesn't mean you're going to invest in those for 1 year and then take your money out and then pay taxes on that and then take the money again, put it into another fund, and hence lose the compounding effect. So that's the reason why I don't invest in actively managed large cap funds. And if my friend calls me and says, where should I put 1 lakh rupees? It's not going to be in an actively managed large cap fund. So where is it going to be? For mid cap and small cap, actively managed, okay, but where is that 1 lakh rupee going to be? A majority of that amount is going to be in index funds, okay? And the reason is index funds are going to be passively managed. They are the index. They're not trying to beat the index. They are the index themselves. So you are basically tracking the index, because beating the index is not a good goal either way, because beating the index has nothing to do with your quality of life. You basically want to preserve wealth and grow your wealth. Why is that an important goal to beat the index? It's not. It's just a social, something that you've picked up from social media or finance talk. But your goal is to basically make money and then make sure that money stays with you and grows over time and beats inflation over time. That should be your main goal, right? So again, I'm not the person to assign goals to you, but that's my main goal. And hence I've made a video which explains why you should not try to beat the index, so do check that video out as well. Now, when you invest in these index funds, you can actually SIP into the market, right? So let me give you a few examples. If you look at my biggest holding, it's Nifty Bees. Nifty Bees is an ETF. I'll explain the difference in a moment, but you could basically go and buy a Nifty 50 ETF and thereby invest in the Nifty 50. And by doing an SIP into the index fund, you'll basically be buying Nifty 50 at different periods of time, when it's high, when it's low, when it's high, when it's low, and thereby averaging the cost at which you buy, and hence in the long term you're basically going to be tracking the market, right? So another way of investing in the index is ETFs. So basically you're investing in the same index, which could be Nifty 50, Next 50, which let's briefly talk about what that is. If you were to list all of the companies in the country, all of the companies in India from number 1 by market capitalization, you don't have to understand what this market capitalization is, but think of it as how big the company is. The biggest company in the country is going to have the highest market capitalization, right? So let's say, for example, in some period of time, it's Reliance. So that means Reliance is going to have the highest market cap. It's going to be number 1 on Nifty 50. Let's say it's HDFC Bank is there in the top 5. And that's going to be in that particular order. So if you were to list those companies, the first 50 companies, the first 50 biggest companies in India will be Nifty 50. And if a company goes from number 49 to 51, it's going to go out of the Nifty 50. If a new company comes in, it's going to enter your investment. So your SIP will be investing in the 50 companies at that given moment when your SIP is executed. So it's an automated process. If a company becomes smaller, Your money doesn't go there. If a company becomes bigger, your money starts going there. So a great way to invest, because it's all automated and the thing is happening by the index adjusting itself, auto adjusting itself, to make sure that your money always goes into the top 50 companies of the country. That's why this is my number one pick. And if I had 1 lakh rupees, or if I had to invest 1 lakh rupees, I'd probably put something like a 40,000 into Nifty 50. Okay, so that's the first thing that I would do. So let's make a note here. From 1 lakh, we have 40K goes into Nifty 50. So we're designing the portfolio together now. And what we are doing here is we are playing safe because we are investing into the top 50 companies in India. But what about the top 100 companies in the US? They also might have growth, and it will also give you some international diversification to invest in US companies. So let's put 10,000 rupees in NASDAQ 100. Okay. So that's going to be my second pick. Now you have 50,000 rupees in large cap companies, because both of these are large cap, right? This is large cap. This is large cap. So now you have 50% of your portfolio into large cap companies, and we have 50% of the pie left to deal with, right? Now you might as well put 50,000 in Nifty 50 if you're 100% reliant on India, but just as a matter of diversification, you could split it 40,000 and 10,000. It's not required, but you could do it. How do you buy the NASDAQ 100? Motilal Oswal has MON 100, which is a great pick that you can make. Okay, now, so ETFs are going to be slightly cheaper than index funds. However, in the long run, to be very honest, there's not going to be a huge difference whether you invest in the index through an index fund or an ETF. So this, for example, my holding is an ETF. That means I'm basically buying it from Kite. But if you were to buy Nifty 50 as an index fund and not as an ETF, you would basically go on the mutual funds tab on Coin and then search for Nifty 50 and go for one of these index fund. Okay, so for example, ICICI Prudential Nifty 50 index fund, you see that the expense ratio is pretty solid. 3-year returns, 2-year returns, you can look at all of this data points, 4-year returns, 5-year returns, and 1-year returns. This is the CAGR, right? Expense ratio 0.17%. You could start an SIP here. I prefer to just do ETFs, and some people might say, no, ETFs don't have SIP and hence index funds are better. But guess what? ETFs also have the option to do SIP. You could go into Kite and create an SIP on an ETF. Okay, there's something new that I learned, to be very honest, because I don't run SIPs. I basically invest from time to time. But for those who want to do SIP, there is an option to do that. Okay, so that takes care of our Nifty 50, and you could also diversify with Next 50. So Nifty 50 and Next 50 are my top two holdings, right? So what you could do is you could basically split this into, let's say, 20K or 25K, 15K, and then do, this is an option, of course. We are developing different kinds of portfolios and you will end up with different portfolio designs, but I'm just making the longer one first, the most diversified one first, and then you can cut it down to different options. So 1 lakh rupees hai, you've put 25,000 rupees into Nifty 50, you've put 15,000 rupees into Next 50, you've put 10,000 rupees into NASDAQ 100, you're left with, again, Nifty Next 50 is also large cap, okay? So Nifty 50 and Next 50 index, if you search about it, you can see all of the companies. I prefer to see it on ticker tape. It's mostly the place that I use. However, any tool is fine. This is the official website, and hence you can see here how the distribution is and what are the funds that are providing it, sectoral distribution. The companies, by clicking on the index, you can see what are the companies in it, what are the companies that the index is currently investing in. Same thing, you can do the research for Next 50 as well. But again, we are talking about market cap. What are the Next 50 companies? So we've covered the top 100 companies of India and the top 100 companies of US already with just 58,000 rupees. So what is covered? Top 100 companies in India. As India grows, your money will grow here. Your 40,000 rupees will grow here. Top 100 companies of US. As US grows, the top 100 companies will grow, and hence your 10,000 rupees will grow here. Now we are coming to the next 50,000 rupees. So now we have to make a decision of mid cap and small cap. So as you can see here, my mid cap ETF is mid 150Bs. So this is going to invest in the next 150 companies of India. So obviously this is going to be mid cap, right? Now, the last one is going to be small cap, which I would recommend doing through a mutual fund. So for small cap, because the universe is huge, it's like 250 companies, I do not like to buy the ETF. Now, this is the only place where I don't buy the ETF, and I would recommend a small cap mutual fund. Is Canada Robeco the best fund? Probably not. Okay, let's be very honest. It's just a fund that I have chosen for a long period of time and I'm invested in. But if someone asks, I would probably recommend Nippon India, which I also have an SIP in. So I'm going to put Nippon India Small Cap Fund. Okay. So if you look at the data points, and I have a video on this with the top 3 small cap funds that you can invest in India, where I've done deep dive analysis between Tata, Nippon, and Canada Robeco. Those are the 3 picks, out of which if one person had to pick only one for their 1 lakh rupees, I would recommend the Nippon India Small Cap Fund. Okay. Now, given your age, okay, based on your age, you'll have to split between these two and your risk appetite. So do your own research and decide. For me, it's going to be 30-20. Okay. This is how I buy these 30-20. So we have 25,000 in Nifty 50, and you could adjust between these two, but basically 40,000 should go into the top 100. Do not buy Nifty 100 if you want to play around with the ratios, because oftentimes you might want to have, as you can see in this case, I have a lot of money in Next 50. It's almost equal to what I have in Nifty 50, see, but Nifty Next 50 has grown by 40%. Nifty 50 has grown by 30%. So I was expecting more growth in a certain period of time in Nifty Next 50, and hence I put in almost as much money as Nifty 50 there, and it worked to my favor. And the mid cap also, if you can see, has nearly as much money as Next 50, right? So what I'm talking is not too far away from my portfolio, which is important to understand, because a lot of times you'll see these finance gurus or finfluencers talking about things but never showing their portfolio, because their portfolio, they might be doing something completely different than what they are talking, because on paper this all sounds great, but in execution they might be doing something completely different. So I'm just showing you for that reason, so that you see that it's tallying with what I'm talking about, right? So this is our mid cap investment, and this is our small cap investment. So this is a very good diversified equity portfolio with a very low expense ratio overall. You're not going to lose a lot of your 1 lakh rupees in expense ratios to mutual funds, with only 1 actively managed mutual funds and 4 ETFs, right? Great way to build a portfolio with 1 lakh rupees. And as you can see, we already had a lot of variations. You could literally just do a 50, 30, 20, which could be 50 into Nifty 50, 30 into mid cap 150, and 20k into small cap fund, any small cap fund. That's another variation that you could do with 1 lakh rupees, right? So this is a simpler option. However, you do not cover the next 50 in this. If you want to cover the next 50 in this, you could basically do 40k into Nifty 50, maybe 10k into Nifty Next 50, or even split it as 25-15 that we did earlier, which could be slightly better, a little bit more exposure into Next 50, and then 30k into mid cap 150 and 20k into a small cap fund, right? What if you say that I do not buy gold outside of my equity and I want to hedge against it within my equity? In that case, what you could do is, okay, 20k, but you have time horizon and you have risk appetite. You might want to reduce the large cap a little bit, and then keep your mid cap the same. Okay, this will be your mid cap, and then keep your small cap the same. And now you have 10% left. So 20, 10, 30, 60, 80. Let's see, 40. Okay. So let's do this 30 and this 20. This is your 100%. So you could literally just split it as 25-15, and now you have 10% left, which you could put in a gold ETF. So now you have gold within your portfolio and you don't have to diversify it outside. So these are different portfolios that you can design with 1 lakh rupees, and based on your appetite, on what you value and what you think and how you want to invest, you could then pick one of those portfolios. And these are all freedom portfolios. The reason why I call them freedom portfolios, they give you freedom. You can sleep better at night. You have no individual stocks in your holdings. You don't have to follow up with all the news. You don't have to watch any more YouTube videos about personal finance. You pick one of these portfolios, and you can even adjust them over time, and then just invest consistently over the long period of time. That's literally the best way to preserve and grow your wealth investing in India. So that's how I would invest 1 lakh rupees. I hope you enjoyed this video and learned a lot from this video. If you liked it, please leave a comment on the video so that I know that I need to make similar videos in the future. Till then, thank you. Thank you for watching. I'll see you in the next one. Ciao.